Hello everyone, welcome back to another video. If you are new to this channel, my name is Farhan and I help accounting students like you ace their exams. Today we have got a practice question for the topic correction of errors. In this question you will learn to prepare the journal entries correctly to correct these errors and also name these errors. We will also look into some accounting concepts. You can see the question on the left hand side of your screen, and on the right hand side we've got all the workings which I'll go through and explain to you step by step. What I need you to do now is focus and follow through for an excellent understanding. With that being said, let's begin. Kish trades in machinery with a financial year ending on 31st of March. The following errors were discovered after the preparation of the trial balance for the business on 31st of March 2021. So here we have got 5 events, 5 errors that we have discovered at the end of the financial year, and our requirement is to prepare the journal entries and correct them. So let's look into the first error that we have got. Payment for utilities of $780 was recorded as $870 in the books. This type of error is what we classify as an error of original entry, and an error of original entry mainly happens when there is an error within the numbers, where you can see the numbers have been misplaced. As you can see, 780 has been written as 870. So the original journal entry that was done in the books by the bookkeeper for payment of utilities would be to debit the utilities expense by $870 and to credit the cash at bank account by $870. So this was the mistake that the bookkeeper would have done, where the expenses would have been overstated by $90, which is the difference between $870 and $780, and the cash at bank account would have been credited or understated by $90 because of the excess payment, which would have reflected in the cash at bank account that the bookkeeper made a mistake. All right, so how do we correct this? So we want to increase our cash at bank account balance by $90, which means we're increasing the balance for our asset account. And when we increase our asset balance, we debit it. So we will debit the cash at bank account by $90, and simultaneously you want to reduce the amount for utilities expenses. As we know, when they increase we debit them, but now that we have to reduce them, we would credit it. So we credit the utilities expense by $90. So the correct entry would be to debit cash at bank by $90, which is to increase our assets by $90, and to simultaneously reduce our expenses, specifically the account for utilities expense, by $90. Let's look into the second error. A check payment of $1,900 to LAM was debited to the cash at bank account and credited to LAM's account. All right, so what I need you to do now initially is to look into the first few words which I have highlighted within brackets. All right, so here you have got check payment of $1,900 to LAM. We want to first look into the correct journal entry based on these few words, where we have just simply made a payment using check to LAM. So how would we record it? The correct way to record this initially would be to debit the trade payable account of LAM, assuming that LAM is a credit supplier and we had a previous obligation which we have just paid off. So when we would have paid off LAM, our obligation or liability towards LAM would decrease, which means we have to debit it, because liabilities, when they increase, we credit it. But now that we are making the payment, we no longer have an obligation, therefore we have to debit it. So we debit the account for LAM, trade payable LAM, by $1,900. And because we have made payment using check, it means our funds in the bank account have been used, which means our assets have gone down. Therefore, when assets go down, we would credit it. So we credit the cash at bank account by $1,900. Okay? So this would be the correct way to record it based on those first few words, a check payment of $900 to LAM. But if you read through the other words that are given, was debited to cash at bank and credited to LAM's account, which is the mistake. And the mistake they have done, the bookkeeper had done incorrectly, was to debit the cash at bank account by 1900 and to credit the trade payable account for LAM by 1900, which is the exact opposite of what we should be doing, isn't it? So in these cases, when you've done the exact opposite of what you should have done, that is what we classify as an error of complete reversal, where the entries have been completely reversed. As you can see in this case, where the debit was recorded as a credit and the credit was recorded as a debit. So how do we correct this? So when you want to get correct this and get full marks for yourself in the exam, what you have to know is that you first need to know how to correctly record it, which is what we have discussed at the beginning, all right? And based on that, we understand that our goal ultimately when we correct, all right, should be to have a final balance of a credit 1900 in the cash at bank account and a final balance of debit 1900 in the account for LAM, who is the trade payable or the credit supplier of the business, okay? So keeping that in mind, we want to change this incorrect entry in such a way which gives us eventually a net balance of credit 1900 in the cash at bank account and a net balance of debit 1900 in the account of LAM. So how can we achieve this? If we credit the cash at bank account as part of a correction by $3,800, what is first going to happen is that the debit incorrect entry of 1900, which we had done before in the cash at bank account, would be first offset entirely, and then it would leave us with a final balance of credit 1900. So that is why we have to credit the cash at bank account by 3,800, which is double the amount, so that the initial debit 1900 gets fully offset, which is what you can see here. And that ultimately leaves us with the final balance of credit 1900 in the cash at bank account. So when you want to correct this entry, you need to credit the cash at bank account by $3,800. We will now follow a similar logic for the account for LAM. So if we debit the trade payable account for LAM by $3,800, what's going to happen first is that the incorrect entry of credit trade payable LAM 1900 would be offset entirely, which would ultimately leave us with a debit balance of 1900 in the account for trade payable LAM. All right. So the correct journal entries in this case is to debit LAM by 3,800 and to credit the cash at bank account by 3,800. Always remember, once you have identified an error of complete reversal, it is always going to be doubled when it comes to fixing it as part of your journal entries, okay? All right, so let's now move to the third error. Repairs to motor vehicles of $700 was wrongly recorded in the motor vehicles account. All right, so this is what we classify as an error of principle, where the error is within the fundamentals. And an error of principle can be identified when the wrong categories are involved. What do we understand by wrong categories? The expense, which we had for motor vehicle repairs, was incorrectly recorded in the account for motor vehicles, which means we have incorrectly increased our assets or shown it as some kind of purchase of an asset, all right? So this is obviously a mistake. So when we would have incorrectly recorded it, what would we have done? So let's look into that. So the incorrect entry that the bookkeeper would have done would have been to debit the motor vehicles account by 700, which is to increase the asset account by 700, which is wrong. So what we have to do as part of our correction is to first credit the asset account, the account for motor vehicles by 700, which means we're reducing our assets by 700. And simultaneously, we will debit the repairs expense account by 700, which is a motor vehicles expense account. And that means we're increasing our expenses, obviously. All right. Excuse me. All right, so now let's look into the fourth error. A check of $420 received from Paul was wrongly recorded in the account of POA. All right, so this is what we classify as an error of commission. And an error of commission happens when the error happens within the same category but in the wrong account. So what do we understand by that? Same category here is referring to the category of trade receivable. So Paul and POA are our credit customers, all right? So they are our trade receivables. And when we received the money from Paul, we ended up recording it in the account of POA. All right, so we know both Paul and POA are trade receivables, obviously falling in the same category of current assets, but the wrong account has been used, which is to use it in the account of POA rather than in the account of Paul. So what we have to do is look into first the incorrect entry that would have been done by the bookkeeper. So the bookkeeper would have done a journal entry that reflects a reduction in the balance of POA or the balance that our credit customer POA owed us. So the bookkeeper would have credited trade payables POA by 420, right? Which is obviously not correct. So to correct this, what we have to do initially is to increase our balance for POA first by 420. So when we increase our balance for assets, we debit it, which offsets the mistake that we have done before. And then simultaneously, we would want to credit the trade receivable account for Paul by 420, who is the credit customer that have actually paid us, all right? So the correction is to debit the trade payables account for POA by 420, and then to credit the trade payables account for Paul by 420. And this is what we classify as an error of commission because the same category of trade receivables are involved here, but the wrong accounts where the payment made by another credit customer was recorded in the account of another credit customer, if that makes sense. All right. So error number 5, credit purchase of laser printer for office use, $590 from Harold Limited was not recorded in the books. So this was not recorded at all. So that is pretty straightforward, which means this is an error of omission. And we just need to record it from scratch. So what we have to do is to increase our assets, which is the printer that we have bought. So we would debit the office equipment by $590. And because we have bought this on credit, what we will do is credit the account for Harold, all right, by $590. Now, you could just simply choose to write Harold, but if you want to be specific in terms of the actual creditor, I would say the best words to use is other payables, specifically the account for Harold. And why other payables and not trade payables is because you're buying this printer for office use, all right? This is not part of your regular operations. You're not dealing with your credit suppliers and buying on wholesale and then selling it for a markup to your customers. You're simply buying this printer for office use and you're buying it on credit, which means this is not for your regular business items that you are selling, all right? So therefore, the best word to use in this case, I believe, should be to use the other payable account for Harold, which is again a liability in itself, and when liabilities increase, we credit it. So that is why we are crediting the account for Harold by $590, okay? All right, so now let's look into part B. Explain the prudence theory. So the prudence theory is pretty straightforward, which is to not overstate your assets and profits and to never understate your expenses and liabilities. So we always want to be very careful in terms of whether we are inflating our performances by showing higher profits. We don't want to do that. We want to make sure our assets have always taken into consideration possible losses, and our liabilities also include any contingencies or relevant measures. So let's think about some examples. So when we present our assets in the statement of financial position, which is the balance sheet, you show the asset at original cost. You also show the accumulated depreciation, which is the total depreciation or the aggregate depreciation that you have incurred for this asset so far since the day of purchase, and you then calculate your net book value, which is simply the difference between the original cost and the accumulated depreciation. Now, the net book value is the remaining economic benefits or the remaining value available for consumption by the business to help it generate more revenue. But we are not overstating our assets, because you can clearly understand that we are subtracting the depreciation, the total depreciation from our original cost. And that total depreciation is the expense which we don't want to understate. So we want to make sure that the costs of the asset is evenly distributed. All right. And in terms of other examples, it could be impairment loss on trade receivables. All right. So based on historical cases, we could identify and come up with a percentage which we believe to be uncollectible in the next year for credit customers or credit sales that we have made this year. So we want to keep some contingency measures here. So we don't want to also overstate our assets. Therefore, we would make sure that the allowance for impairment of trade receivables have been factored in when we present our assets in our balance sheet. So again, this is part of the prudence theory on why we do things like this, where for non-current assets, we would like to show the total depreciation, and for current assets such as trade receivables, we would like to show the allowance for impairment of trade receivables, and then also show the impairment loss on trade receivables or any reversal of impairment loss in our expenses. Okay? All right. So part C, explain why a business prepares a trial balance at the end of the financial year. All right. So a trial balance simply checks the arithmetic accuracy of ledger accounts. What do we understand by that? So we are checking whether total debits equal total credits. All right. So that is the first reason for why we prepare a trial balance. And the second reason is to ensure that the list of balances that we have, they can be used to prepare the financial statements, which are the statement of financial performance and the statement of financial position, also known as the income statement and the balance sheet. All right, so part D, state the role of accounting. So accounting is simply an information system that provides the stakeholders with information to make better decisions regarding the management of resources, capital allocation, and performance of the company moving forward. Now, who are these stakeholders? The stakeholders could be the investors in the business, the shareholders of the business. The stakeholders could be the creditors who have lent you the money. So anyone who is affected, basically, all right? Based on the company performance and how the company manages the resources. So that's all for today's lesson. If you found value in this content, make sure to drop a like and subscribe to this channel, and check out my course, which I am starting soon, that will help you prepare for next year's exam. With that being said, I will see you in the next lesson. Thank you.